Assalamualaikum warahmatullahi wabarakatuh. I will explain on the accounting entries for dissolution of partnership. We know that upon dissolution of the partnership, we should close all the accounts as they have in the statement of financial position. Okay, so the first step will be we need to close all the assets account by debiting our realization account and crediting our asset accounts using the book value as stated in our SOFP, except our cash and bank accounts. So in the process of dissolution of the partnership, we will open one account called as realization account. So what is realization account? Realization account is the account that we open temporarily in order to calculate either we get a gain or loss on dissolution. Okay, so if you look at next example, so suppose we have this situation. In the first step, what we should do is we will close all the asset account. Here we have furniture, inventories, and account receivable. So by suppose we open a realization account. So we will put on the debit side, transferring all the assets value as in your SOFP, furniture 1,300, inventory 700, and account receivable 2,300. So this will be in the first step where we have to close all the assets account except cash or bank account. Okay, next in step 2, we have to pay off all the liabilities, for example, our payables. So when we want to pay our payables, we have to check the amount that we have in SOFP, and then we will pay what will be the actual amount owed. And suppose we pay less than that amount, the differences represent our discount received. So if we have discount received, the amount of discount received will be credited in the realization account, and the amount to be recorded in bank account will be our actual amount paid. Okay, so based on next for this example, suppose we have the amount of payable is 1,000, right? So from the statement, they mentioned that the amount of liabilities will be paid. Okay, so that means suppose this is our account payable. This is liability. So the opening balance will be on the credit side, 1,000. So we expect that all the liabilities were paid. That means cash or bank will be on the debit side. Okay, here we can see that they have paid the amount of liabilities or payable in full. The one that I did mention just now is when we pay less than that amount. So suppose this is our account payable with an opening balance of 1,000, and then suppose we just pay only 800. So the remaining of 200 is actually to be transferred to realization account. Okay, that is in step 2. Step 3. So in step 3, I divide into 5 sub steps. Okay, the first one is when we decide to sell our assets. Okay, so asset that we have, the partnership has, they need to decide whether they want to, what will be the amount to be charged on their asset to be sold to the third parties. Okay, every time they get the collection from the proceed of sale of asset, they will receive money. That's why we will debit our cash, and we will credit our realization account. So based on this example, suppose we have, this is our realization account. So just now we have already debited the actual amount from the SOFP. So here they did mention that the furniture was sold for 1,000. So back to my last slide. So what we have just now, we should debit our cash or bank and credit our realization. So here we will have here, credit our realization 1,000 from the selling of our furniture, and so on. Okay, that is in step number 3. Okay, next, upon dissolution, we also need to collect the amount from our receivable, and the best practice is if we manage to collect the full amount from our receivable. So if let's say we receive less than the amount as stated in our SOFP, the differences is actually representing our bad debts. Okay, so back to this example. So if we have the amount of receivable is 2,300, we only manage to collect from our receivable is at the amount of 2,000. So that means this 300 considered as bad debts, right? So in terms of the accounting entries, what we should do is we should credited our realization with cash from the collection from our account receivable based on the actual amount, which is 2,000. So just ignore that 300 because we have already considered that 300 in our realization, because we have in the first step we already transfer our receivable at the full amount of 2,300. So the difference here represent our bad debts. Okay. Step number 3 is regarding any assets being taken over by partners. So we will debit our partners' capital accounts and credit our realization account based on what will be the price that they agreed to take over. So again, based on this example, we have Rama, which is agreed to take over inventories at the value of 500. So later on in our realization account, so what we should do is we will put on the credit side as cash, to put as capital Rama, based on the value, takeover value, which is 500. Okay, so the same concept as asset sold, but the only main difference is in terms of the double entry. If being taken over by partner, we should debited capital account for that respective partners. And if we sold to the third party, we sell to the third party, then we should put as cash. Next step, also in step 3, on paying the dissolution expenses. Suppose we have dissolution expenses that should be paid while we try to clear off all the assets. We hire other party to help us to settle down all the process of dissolution. So that expenses we should pay. So that's why the cash account or bank account will be credited, showing we have to pay, and debited our realization account. So here we have dissolution expenses or expenses of realization of 200. So later on in our realization account, should put on the debit side, showing the expenses on the realization of 200. So later on in our cash account, we have here realization of 200. Okay, and last one is close of our realization account. So if from the transaction that from the accounting entries from step 1 until step 3 part 4 just now, there are some accounting entries that mainly related to the realization account. So now this will be the time of closing or balance of our realization account by looking at any balancing figure, and if the balancing figure on the debit side of realization account, it shows that there is a profit on realization, and if the balance is on the credit side, it shows that there is a loss on dissolution or loss on realization. So if you have this realization account, so suppose after you have considered the transaction on the debit side and on the credit side, then if you get a balancing figure on the debit side, so it shows that this will be a gain on dissolution, and if the balancing figure on the credit side, this is a loss on dissolution. So what we should do with this balancing figure, either we get a gain or loss, we should share this according to profit sharing ratio. Okay, suppose you get a balancing figure on the debit side, so that is gain on dissolution, you share according to profit sharing ratio. Same goes to loss or credit balancing figure in the realization account, you should also share according to profit sharing ratio. Okay, so that is in step number 3. Now, after we managed to do the accounting entries until step 3, so we can see that our furniture have been closed, inventories, account receivable have been closed. Just now we have in step 2, we have considered the liabilities, that means we have closed these 2 accounts. The remaining account that's still open is cash and capital accounts. So the next step, which is in step number 4, is we need to close current and capital accounts. So there will be 2 situations. If our partners is abnormal, it means that the current account is on the debit side. So we will transfer, or we will close the balancing figure in the current account to capital account, but on the debit side in the capital account. The other way around with the credit balance in the current account, we will transfer or close current by transferring to credit side of the capital account. So the second situation will be a normal balance for partner's current account. The first one, when the partner's balance is abnormal. Abnormal means debit balance. So here, okay, suppose you have a current account. For this one, we don't have any current account. So suppose we have Rama and Lim. If let's say balancing figure for Rama is 1000, so we will close by transferring to capital account for Rama with that amount, 1000. Okay, so same goes to Lim. Suppose Lim, the opening balance is abnormal on the debit side, so he will also be transferred to capital account, but to the credit side in the current, and later on in the capital will be debited. Okay, suppose this is capital. So for Lim, you have on the debit side 500. But for Rama, it will be on the credit side. Okay, that is in step number 4. And when we have transferred all the figures or all the accounting entries starting from step 1 until step 3 and even in step 4, we expect that the balancing figure in the capital accounts will be in this side. Since this is the dissolution of the partnership, what we should do is we have to clear off all the accounts. So for capital account, there will be no more balancing figure ataupun balance carried down. So we should transfer to cash or bank account. Okay, that will be in step number 4. So what does it mean? It means that if upon dissolution, Rama and Lim will receive a refund from the partnership, depends on how much the amount of capital left at the end of the accounting entries. Okay, so this amount will be credited in the cash account, showing that the partnership will pay to Rama and Lim, to partners, as a refund of their capital. So that will be in step number 4. Once we did that, so it shows that our capital has been closed. Capital and current will be closed. Okay, the remaining account that is still open is our cash account. This will be the last one that we will close. And now this is in the next step, step number 5. It shows that how to close cash or bank account depends on the balancing figure in the capital accounts, partners capital accounts. If the balancing figure is on the debit side, just the same as I did explain just now. If the balancing figure in the partners capital account is on the debit side, so your cash bank will be credited, showing partnership will pay or refund to partners. Right? In the second situation is sometimes the balancing figure for partners, you have the balancing figure is on the credit side. Okay, if the remaining is on the credit side in the capital account, it shows that that particular partner need to pay to partnership. So in this situation, partner will be the one. Partner need to pay to partnership to clear off the balancing figure just now. That's why the partnership will receive debit cash bank. Okay, and in this last step, after we close cash or bank account, we should know either we did the accounting entries correctly or not by looking at the total of the debit total and credit total in the cash account. It should be equal, exactly equal. Okay, so your cash bank will exactly equal. Then it shows that your accounting entries is correct. So here, suppose we prepared our cash account. We already put the opening balance. We already considered any cash being sold. We already considered the cash collection from receivable. And then on the credit side, how much we pay to our payable or liabilities. How much is the expenses on dissolution. And last one is how much we need to pay to our partners, to refund to our partners. So lastly, this total, debit total, should be equal to credit total, right? And our cash account will be zero balance. So that will be the way on how to do the accounting entries for upon dissolution of the partnership. Okay, so thank you.